Today's class, December 6, 2011, is going to be on Fibonacci profit targets, both the ones that you can draw yourself and the ones that I draw every night for you. I spend about 30-45 minutes every night drawing Fibonacci areas on there, both the Fibonacci retracement areas, which are the light gray, and the Fibonacci profit targets, which are the dark gray. You can add these to your charts by going to Add Script, and it's underneath trading zones. And the trading zones are made up of two different areas. One are the normal support resistance areas, previous days, weeks and months, high and low, daily, weekly, and monthly pivots, and some other areas. And they start showing on your chart when the price has moved 85% of what a normal day's volatility is. So let's say the euro dollar, or in this case the euro yen, moves 100 pips a day on average over the last 20 days. We would start showing you major support resistance areas 85 pips up and 85 pips down from when the day starts. That's what these red, and if the market had went down even more, green areas are. The second part of the trading zones, and they show up wherever they happen to be, wherever I draw them at, is the Fibonacci profit target levels, like you can see here, dark gray. The dollar Swiss nailed the high today, and these are Fibonacci profit targets, so I'm going to start with them. I use multiple time frames when I'm doing these, and I'll probably have other classes that show you how I do this, but you don't need to do them yourself because they show up on your charts automatically. And it's typically off of the previous days or day and a half or even 3 to 5 days moves, very likely high probability areas. And when these Fibonacci profit target levels are underneath our containment bands, typically price is very likely to reverse. And a lot of times you get a little double bottom there before it reverses, and you can also use range bar charts to increase your odds. When one of these Fibonacci profit target dark gray areas is underneath the lower band, it's very likely to reverse. And so you typically are going to want to use a range chart, which I happen to have up. Here's the euro yen 6 pips per bar chart. If you get a little double bottom pattern right there, usually you're going to get a reversal. And most of the time when prices reverse at and below the lower containment band, they will work their way up to the hourly moving average. This is a decent profit target, right? It starts off at 104.22, and over time it kind of falls to 104.15. Doesn't mean you have to hold that far. You can buy it here when it breaks out at 103.73 with your stop a pip or two underneath the low. As soon as it kind of moves up and goes sideways here, that's not always a good sign, so you want to move your stop up a little bit. You'd only lose 5 to 7 pips at that point, and then it takes off. And you always want to use support resistance areas as possible profit targets. It goes to the previous day's low, and it really has a hard time going above it. So again, you want to yank your stop up, and most of the time put it right underneath here, and you got out of this trade at 103.97. In at 72. So you made about 23 to 25 pips after your spread, and you can see the market came back. If you wanted to use the trailing stop to get out, you would have got out of this trade here at 94 versus 97. You get back another 3 pips. Once the market goes up and pulls back, this is another Fibonacci lesson in progress here. Most of the time when it pulls back to the 50 or 62%, it's going to find support, especially if the weakness is less than it was before. It's pretty deep. You have a good chance of this going back up. You don't know it's going to go above these highs, but let's say it goes back up to the highs. Kind of take the middle of that zone, and this would be your profit target right here, 104 or so. If you bought this at 103.86, you have a 14 pip potential profit target. And again, sometimes markets go farther than you anticipate. That's great news, but you're estimating whether you should take a trade or not. Take a trade that is likely to go 1.5 to 2 times more than your risk. So put your stop at 1 or 2 pips underneath the low. You would buy here at 103.87 or 88. Your stop is at 79. So with the spread, you have about a 12 pip risk. Your profit target's a little bit more than that. Anytime a Fibonacci area down there gets hit, goes up and then pulls back down with less weakness than there was before. Typically, this is a good example of a 1, 2, 3 low, and this is your first profit target. It shoots through there. Here's your next one. Shoots through that. I probably would have got out of my whole trade somewhere up around here at the hourly, and in this case, it continued up even higher. If you want to exit half your trade when it's stalling at a resistance area, and then yank up your stop underneath these bars low, you can do that. And then you can see the next area where it kind of stalled. And guess what? It's the 1.618. Like I said in today's Forex blog, probably 70-80% of the time, the market doesn't go beyond the 1.618 fib target. And this fib target right here is the same thing that found the low today. I don't think this chart has the trading zones on it, so it's a good thing that I can add it to it right now so you can see how to do it live. Go to trading zones, oops, and simply hit add script, and then you can see it on your chart. These are very high probability areas to buy at, especially if they're at and underneath the lower containment band. And I would say at and underneath the white band. They're significantly less likely to work if it's just at or below the red bands. Red bands get broken all the time. So at and below the white band, the market has really gone an extreme distance, and there's less likely to be sellers selling it at such an extreme low. Now let's go over another example today, the dollar Swiss. Guess what? Fibonacci profit target was the high, and it's also above the upper band. Now I don't have a range chart having run this throughout the night, but it's always good to see. This one kind of, I don't know if this is a real price print or a false spike on the data feed, but you can see it went up with a lot of strength, came very close to it right here. I don't know with this kind of strength I would have sold it, especially since the daily, weekly, monthly trend is up. But as it's going sideways right here, you can see the strength's gone. So again, if it breaks the low here, you sell it, and here's your first profit target because it's the previous month's high. That's a lot of times currencies that go above the previous month's high, when they come back down, they're going to find support here. So this is your profit target. Normally, I shoot for the hourly, which is where it actually did go to. But you always have to estimate conservatively to see whether it's worth the trade or not. So this price is at 0.9242. You are shorting this if it goes a pip underneath these bars low at let's say 65. So you got a 23 pip potential profit target while risking less than 10 pips. Your stop is a pip or two above these bars high. And, again, that's less than 10 pips because, well, let's just see for sure here. 65, 73. Yeah, so with a spread, it's about a 10 pip risk. You're going to be making, if the trade goes down here, about 2 times what your risk is. And because this major resistance area is right above it, less professional traders are willing to buy right in front of a major sell area. Until it comes up to that area, at least again, and then penetrates that, aggressive buyers aren't going to be buying right in front of an area that's likely to stuff them. And what I mean stuff them is if a trader did buy up here as it starts to go up, it's not likely to go through here. And so why take a trade that's only likely to give you 5 or 6 or 10 pips? It doesn't make any sense. So having a resistance area up there gives you increased odds of this pulling back. Usually resistance areas get hit once, twice, and then if the market doesn't reverse off of them the third time, they go through. That's why I frequently say whenever you buy or sell support resistance, do it the first and second time, but never the third, because the third time will get you killed. The only time I would want to buy a breakout above or below a support resistance area is if it got hit twice, and then the third or fourth time, you can buy or sell breakouts. So this trade you would have been in, and the market came down here and stalled. You don't know it's going to continue through there. So I would exit half the trade here and put my stop right above these bars high. This is my next profit target, shot right through it, and then the next profit target, and the hourly. This is a cluster of support. Anytime you have the previous day's high, or actually any support area, 2 or 3 of them within a 10 or 15 pip range, tends to be very high probability end of the move. And considering that this has an extremely strong daily, weekly, monthly trend, the longer term trend is up very strongly, it's more likely to find support here. And so when it goes sideways, you're going to get out of the second half. So you would have exited the second half here at 92.27, maybe the first half at 42. So your average, let's just approximate it, your average exit was about 32. You're short up here at 65. So you made 30 pips while risking 10. That's a 3 times bigger win than loss. And if you've ever read Van Tharp's book, he uses R multiples. This would be a 3R trade because the profit is 3 times what your risk is. And you should also do that in analyzing your trade too. If your first profit target is 20 pips and you're risking 10, that's a 2R trade. And focus on trades again that are likely to go 1.5 to 2 times more than what your risk is. So then again, later today, the market works its way back up here, and kind of went up here and stalled, went up here and stalled. You should always draw your fibs on there to increase your odds at the high. And this move from 20 all the way up to about 55 gives you pretty accurate Fibonacci profit targets. And like I've said earlier today, most of the time, 80% of the time or so, the 1.618 is the end of the move. On top of that, we have a counter trend sell signal here. And as this goes up and down again right here, you can see the strength is starting to subside. So because this has already found resistance there before, it's pretty safe to assume the double top will as well. You might get short once it kind of stalls here for a while and runs out of steam. Maybe you're short somewhere around 79. And as this thing starts to pull back, look, the weekly pivot level is a support area. It didn't penetrate that. On our range bar chart, you might have got out of half your trade up here and then the second half here. So the average exit might have been a 70. You're short at 77. You didn't make much on the second trade. Now, with the major resistance above here, it hasn't really pulled back much the second time. So it could go sideways here for a while and shoot up. It probably will go through this level the next time. Or if it goes sideways here and can't make a run for the top, you probably would want to sell it later today if it broke the 92.58 area. This is your first profit target. If it breaks that, you have this and this. And if it breaks that, then it could really go to the lower bands, which might be another 30 to 50 pips down. So, give a trade every opportunity to continue higher. But if it's not able to go higher, it's probably going to pull back as everyone runs for the door at the same time.